Hey, all right, in the last few videos, we've been talking about bullish strategies, specifically bullish option strategies, which are buying call options. And you want to know why? Because the market's been going up. Everyone wants to get on board. They want to buy call options. They're bullish. And they come to me and they say, Lee, which call option strike should I buy? Should I buy an out of the money, an at the money, and in the money? They're just not sure what the best thing would be for them. So in this video, we're going to go over each one. We're going to look at an out of the money, an at the money, and in the money call options, and kind of look at the pros and cons of each and why you should maybe choose one over the other. I get lots of questions about it. So in the video, I'm gonna show you my spreadsheet. We're gonna look at the charts and we're gonna look at some option chains, and we're gonna figure out, which one, not so much the best, but which one, what's the best choice for you based on your, the size of your wallet and how you think the stock's going to move. Okay, so these are some of the things that you need to think about. All right, so let's just jump right in and start looking at these things. All right, everyone, Lee Lowell here from smartoptionseller.com. Why is everyone bullish? Why does everyone want to buy call options, which is a bullish strategy? Because look at the market, okay? This is the chart, daily chart of the SPY, which is the exchange traded fund for the S&P 500. We had the down move from mid-February to, roughly early April. And then look at this bounce. This is what's called a V-shaped bounce, V-shaped. And here's we are right here, traded Friday, June 6, 2025. And here's the all-time highs in the S&P 500. We're getting close to that. So everybody wants to get on board. They want to buy call options, but they're just not sure which strike to buy. So let's take a look. We're going to look at a hypothetical trade on Apple. We're going to look at a couple different strike prices, and we're going to figure out, why would you want to choose one over the other? All right, so let's bring up Apple here real quick. And just to back up here, we're going to talk about, what does in the money, out of the money, and at the money mean as it pertains to the option strike prices. When you buy or sell an at the money strike, that means its strike price is closest to the current price of the stock. When you're buying call options that are out of the money, their strike prices are listed above the current price of the stock, and the in the money call options are listed below the current price of the stock. In the money options have intrinsic value, has real value already built into it. The at the money options are more of a 50-50 chance, and the out of the money options, if you're buying out of the money options, you're really speculating. It's more of a speculative trade because you're saying, I really know where the stock's going to go to in a certain amount of time. Now, one thing we all know is that options contracts have expiration dates, and what I found is that most people are pretty optimistic about their stock picking abilities and where they think the stock's going to be at a certain date. The bottom line to succeeding with options trading is that you have to know where the stock's going to be by a certain date, especially if you're buying options. There's no other way about it. If the stock doesn't move in your favor when you're buying options, you will lose money. That's why we like to sell options, which we'll talk about in a little bit, because selling options doesn't require you to be pinpoint accurate on picking the direction of the stock. But in this case, we're talking about bullish, we're talking about call options. We're going to go over the at the money, in the money, and out of the money strikes. So we're looking at Apple here, and we're just assuming that someone's bullish on Apple and they're trying to figure out which call option to buy. Here's Apple. It's sort of in a downtrend right here. May have found a bottom here. It's trading, right around the close on Friday, June 6th at 203.92. So we're going to look at some strike prices based off of that number. So let's bring up my spreadsheet here. We're going to talk about what I've done here and how we're going to look at these numbers. So I've got three different groups of numbers here. Now, let's just talk about this for a second. You always have to compare option contracts to 100 shares of stock. Every option contract contains 100 shares of stock. So we have to make sure we compare each option to 100 shares of stock. So in this case, if you're going to buy 100 shares of Apple, it would cost you, in this case, we use $204.50 as our price of Apple. $20,450 is what it would cost you to buy 100 shares of Apple. And I've chosen three different strikes here. One is in the money, one's at the money, and one's out of the money. And we're only going to concentrate on buying one each of those. Now, people will say to me, well, if it costs $20,000 to buy 100 shares of Apple, why don't I just buy $20,000 worth of call options, which is something you can do. But in that case, most people buy call options because of the leverage they get. Instead of paying $20,000 for 100 shares of Apple, you're going to be able to buy these call options for thousands and thousands of dollars less. But you're still going to be able to track those same 100 shares. Now, if you bought $20,000 worth of call options, your upfront cost is still $20,000. So you're not really getting all the benefits of buying call options. That's why I want to focus on these two. These first two here are based on using one call option contract. And here's the numbers that if you were able to buy $20,000 worth of call options, and we'll look at that in a minute. So what we've done here is we're doing a hypothetical. We're going to look at the option chain. So let's bring up the option chain real quick. And I have Apple pulled up for a hypothetical August 15, 2025 expiration date, which is 69 days in the future, which is what most people concentrate on. They like to concentrate on these shorter dated options. Options have all different expiration dates. You can do a 0 day expiration option, a 1 day, a 1 week, 1 month, 3 months, 6 months, 1 year, almost 3 years into the future, these options go out to. So for Apple, the longest expiration date is December 2027. So, about 2.5 years from now. But we're going to look at this shorter dated option. And we're going to look at 3 different strike prices. We're going to look at the 170 calls, the 205 calls, and the 250 calls. Now, why are we looking at those? Well, as I said, the at the money strikes is the strike that's closest to the current price of the stock. Here's Apple in the after hours, trades until 8 p.m. Eastern, 5 days a week, 204.47. So we're going to round it up to 204.50 for Apple's current price. So the 205 strike is the at the money. We're going to look at the 170 calls because when I buy in the money calls, I usually choose a 90 delta. The couple columns you want to have here, obviously the strike price. You want to have the delta column and the bid and ask price. These are the things you want to have in your broker's platform or whatever option chain you look at. And what does the delta tell you? The delta tells you how much the stock's going to move in conjunction with how the stock moves. So a 90 delta option, deltas range from 0 to 100. 0% to 100%. So a 90% delta means this option contract, this 170 call, is going to move 90% of whatever the stock does, higher and or lower. So you want to have your option move. If you're going to buy options, you want it to move when the stock does. The 205 calls, which are the at the monies, has about, always, roughly 55% delta, which means if Apple goes up $1, the option price will move up about 50 to 54 cents per contract. And these 250 calls are just way out of the money. They're really cheap and they cost 68 cents per contract, which is 68 actual dollars. Every option contract consists of 100 shares of stock. So whatever numbers you see in your option chain, you have to multiply it by 100 to tell you the actual dollar cost. So we're looking at the 170 calls, which are going to cost, we always do something in the middle, $37.05 per contract. $37.05, which is $3,705. If you were to buy this contract, it would cost you $3,705. If we were to buy the 205 calls, it would cost $1,095. And if you bought the 250 calls, it would cost you $68 compared to $20,450 for Apple. So right off the bat, any option contract you buy is going to cost a lot less than buying 100 shares of Apple. That's your leverage right there. Now, it comes down to, well, which strike price do I choose, or why do I want to choose one over the other? And there's lots of different things to consider. Most people at first blush will say, oh, well, why don't I just buy these 250 calls? It's only going to cost me $68. But you have to think a little bit more than just the cost. You have to think about, where does the stock need to get to and what are the chances of it getting there in order for me to make money? So the first thing that you always need to do whenever you're going to buy a call option is figure out what the break-even price is going to be for you to start making money. Okay, so if we buy the 170 calls, the way to figure out the break-even is you take the 170, and add it to the cost, which is 37.05. That would mean Apple has to go up to $207.05 in order to break even if you bought this call option. Apple's at $204.50. It only has to go up to $207.05 in order to break even. So in the next 69 days, I think Apple could get above $207.05. Now, if you bought the 205 calls for $1,095 or $10.95 per contract, you add that to 205. So that's $215.95. Apple has to jump to $215.95 in order to just break even. And I'm talking about holding these things all the way to the expiration date, which is 69 days. There's the way to know the concrete numbers is you hold the option to expiration date and you'll know the final numbers at that time. Now, there's no reason that you have to hold the option all the way to expiration. You can get out at any time you want. And that's something that I always tell, my newer students that come to me, and I tell them, look, if you have profits built up, if the stock moves in your favor very quickly, consider taking profits, because if you hold it longer, there's always a good chance the stock could come back down and you'll lose those profits. And they say to me, well, I bought an option for 69 days. Why don't I want to hold on to it until the end, because maybe the stock will keep going up? Yes, that's true. But a lot of times the stock will make that initial move and then it'll just kind of go sideways and kind of crap out, and maybe it doesn't go anywhere else, and then the option will give back all its profits. So one thing I'll say to new students is that if you have some profits, it's okay to take them, even if you have a lot of time left before expiration. And if you want to, stay in the game, buy more than one option contract. If you buy 2 option contracts, you can sell one out, take the money and run, and now you're playing with the house's money. But that's something for another day. All right. So we're looking at these 3 trades: the 170 call, the 205 call, and the 250 call. And the break evens are, we're looking at the 205s. The break even was $215.95. And then if you buy these 250 calls for 68 cents a contract, the break even price of Apple is $250.68. Apple has to go really high in order for you to make any kind of money on that option if you hold it until expiration. Now, if Apple jumps up really quickly, all these contracts will make money, but you have to take the profits when they're there. If you don't, and the stock doesn't stay up where you need it to, the profits will evaporate. All right, so let's look at our spreadsheet. I made a little spreadsheet here, and we're going to look at some of the numbers, and I'm going to show you the percentage numbers, the dollar numbers, and then if you were to buy $20,000 worth of options contracts, here's the numbers down here. We'll go over that in a little bit. So here's a little spreadsheet, and we're going to look at various stock prices of Apple going from $0 up to $300. I'm going to and you can see the dollar values that each one will make, and in this one is the percentage numbers that each one can make. Now remember, we're looking at 100 shares of stock and 1 call option in these first 2 sets of numbers right here. And then down here, this is the set where you can buy $20,000 worth of each option contract. Okay, so let's see what we've got here. Now, thinking on the defensive side, on the downside, if Apple craps out and goes to 0, everybody's going to lose money no matter what. The stockholders are going to lose the full $20,450, and the call holders are going to lose everything as well. And percentage-wise, it's 100%. You lose 100% of your investment, but obviously the dollar amounts is what's most important in my opinion, because dollars are dollars. Percentage really doesn't mean that much to me in this case. So as the stock price moves up, if Apple falls to 150 from its current price of $204.50, here's the numbers. The stockholders will lose. All the call holders will lose, as again 100% of the investment. Now, if Apple's at $204.50, which is where its current price is, the stockholders don't make or lose any. The option holders are still going to lose money. Obviously, the 250 call owner can never lose more than $68. So, that's their consolation prize. But here's the numbers for the 170, 205 call. Now, once Apple gets above if it's at 225, here's the numbers start to get positive, except for that 250 call. The stock and the 170 deep in the money call are kind of closely tracking each other with dollars. The 205 call is about $900 behind the 170 call. If Apple was to jump up to 250, still the stockholders and the 170 call holders are still in that almost, a $260 difference between those. And then the 205 call is still about $900 behind. And the 250 call owner is still losing money. All the way 100% loss for the 250 call owner, even at 250. Apple's moved up to, $45 in price, but the 250 call owners on expiration are still losing 100% of their money. And here's the percentage returns at 250. Now, obviously, the 205 call holders can have the best percentage gain because when they finally make money, because they only had to put up smaller amounts. And you can see the percentage return for the others. Now, at $300 a share, everybody's making money on Apple. Here's the stock owners, the 170 call owners, the 205 and the 250 call owners. Everyone's making money. Here's your percentage return. And the big one is the percentage return of 7,253% for the 250 call owner. But Apple had to go up, almost $100 a share in 69 days. So you have to decide, and here's your break evens right here. If you wanted to know, it's just I wrote this out for everyone. So you have to understand is it possible for Apple to go from 204.50 all the way up to 300 in 69 days? That's where the probability comes in, and we'll look at the probability calculator in a second to see what Apple's chances are. Most people, they don't know what their probabilities are before they jump into a trade. They just think, I'm just going to buy an option, and well, here's how much money I got to pay, and hopefully I'll make money. Hopefully they'll stock up. Hope is a big part of a lot of people's strategy. They just hope the market goes up by the amount, the expiration date. And that's what you're doing when you're buying out of the money options. Hope becomes more of a thing in your strategy, where if you buy the 170 call, the in the money call, it's really moving just like the stock. So whatever the stock does, most likely the 170 call, because it has a 90 delta, is going to move just like the stock. This 250 call has maybe, like a 4 or 5% delta, not moving very much. Okay, so here's your percentage returns. Down here is the numbers I used. If you were able to buy $20,000 worth of the stock and $20,000 worth of the option contracts. Okay. Now for the 170 calls, which cost $3,700 each, if you had $20,500 to play with, you can buy roughly 5 of these call options. Okay. With the 205 calls, you can buy roughly 18 contracts. And the 250 calls, you can buy 300 contracts because they only cost $68 each. 300 times 68 is roughly your $20,000 investment. Now, once again, if Apple craps out and goes to zero, everyone's losing roughly the same amount of money because everyone's putting in the same amount of money. You're putting in the same amount for each contract. If Apple's at 150, you can see the stockholders are the ones losing the least amount. And then once it's at its break even, here's the numbers again. The 170 call owners are losing the least amount of the call option owners. And then as we get higher in price, you can see the numbers start to go up. So even at 250, the 250 call owners are still losing the maximum, $20,400, where everyone else is starting to make money. Now the 205 calls are starting to they're really starting to overtake everything else. So if the stock really moves up in the time that you need it to, having more contracts helps you make more money, but the stock really has to move. And here's the end game at $300 a share. The 250 call owners finally get their payoff. They're going to make almost $1.5 million from their 300 call option contracts. And they're going to make like a gazillion percentage. The percentage actually should be the same right here. So yes, if you real speculative and you're taking that lotto chance, the 250 calls is your answer right here. But the stock has to go. The stock has to move up. If you want to be more conservative and play with the odds, then your in the money trade is really the way to go, because you will track along with the stock higher and lower for the most part. And you're still going to make a lot of money. Okay. Remember, if we were buying one call of each, here's the dollar values. The dollar values are roughly all the same on the way up at the very end, except the 250 call owners aren't making as much. So these first three here, the stockholders, the 170 call owners, and the 205 calls are roughly making the same amount to a degree. But if you bought the $20,000 worth of call option contracts, then you're going to really see the dollar values go. But, you're taking a speculation. So that's the difference. Me, personally, I always default to the deep in the money. I call them deep in the money, a 90 delta option. Those are the call options that I personally like to buy, because I know I'm tracking the movements right from the get-go for the most part. And its break even is pretty close to the stock's break even. Now, if you wanted to figure out the probabilities, let's take a quick look at the probability calculator. Okay, I pulled up the probability calculator from our website. Now we're going to put in the price of Apple, 204.50, and we're going out 69 days. And the probability calculator is going to tell you what are the chances of Apple getting from its current price to your break-even price. And so you'll know what your chances are. Now, the volatility we can look at, let's go back to the option chain. A quick way to find the volatility is for the month that you're using, you can either use the at the money implied volatility, 29.8%. Each strike price has its own volatility. So we're going to use roughly, we'll use the at the monies, which is about 30%. Okay, so we'll put 30% in here. And you can also get that information on the internet. So the first target, obviously, 204.50 is the break even of the stock. So you know if you buy a share of stock, you have a 50-50 chance of making money. The stock's either going to go higher or lower on that next tick when you buy a stock. So click go. So obviously you can see finishing below the lowest target or finishing above the highest target. The targets are the same price. So you have 50-50 chance. Okay, that's if you bought the stock. Now, if we were buying the 170 call, it's 207.05. We're going to put that in each box, 207.05. Click on go. Now, we want to know the chance of it finishing above the break even. So it's got a 46.2% chance. As I said, you're never going to get higher than a 50% chance. So 46% is pretty good for the 170 call. Now, the 205 call, the break even was 205.95. Put that in each thing, 205.95. Click go. Now you have about a 33.8% chance for Apple getting above your break even in the next 69 days. Still not too horrible. And lastly, let's look at the 250 call owners. That has to go up to 250.68, 250.68. And the chances of 5.9% of Apple getting up to just your break even, just to break even, 5.9%. So this is the reason why. The option that costs the least has the least chance of winning. The option that costs the most, which is the 170 call in this case, has the best chance of winning out of all the call options. Okay, so you want to check your break-even prices and check your probabilities. So once again, what is there a better choice to make? There's no right or wrong. It's up to you to decide. You can choose any one you want. I'm not here to tell you which is right or which is wrong. For me personally, I always choose a deep in the money because I want to get the most bang for my buck, meaning delta, high delta, which means the option's going to move almost tick for tick with the stock, which is what I want to happen. But it's going to cost me a hell of a lot less. $20,500 to buy 100 shares of Apple, or $3,700 to buy that 170 call. I'm saving a hell of a lot of money. Yes, I could buy it for $68, the 250 call, but I need Apple to go really far before I make any kind of money. That's pure speculation in my opinion, okay? So I hope this has been helpful. If you want to see I wrote an ebook about using the deep in the money call option based off of Warren Buffett. So let me go to our website here. This Warren Buffett ebook. Okay, Ride the Coattails of Warren Buffett. If you want to see how I did a study on using the deep in the money call strategy along with Buffett's Berkshire Hathaway fund, and you'd be pretty amazed at some of the results that we got. Updated it for 2025. I wrote it a few years ago, so I updated it. If you want to take a look at this, just click on the picture. It'll take you to the next page with all the details. Now, I told you that we're more sellers of options at the Smart Option Seller. This is what we do. Let's go to our homepage real quick. You can go to smartoptionseller.com. We sell put options and put option credit spreads. That's our thing. That's our gig. We love selling out of the money put options because it has such high probabilities of being profitable. You don't need to get the direction right in order to make money by selling out of the money put options. The stock can move in a huge range and you can still make money. Conversely, if you buy options, the only way to make money is if the stock goes in your favor. So you have a lot more cushion for error when you sell options. So if you specifically want to learn about selling put options, go to our website, click on our free ebook, Put Selling Basics. Put in your name and email address right here, and we'll send you an email back with a link for the free ebook. And if you want to take a little deeper dive into what put selling's all about, we have a couple seminars during the year, live webinars. These are recordings from the webinar. It's a 5-part series, 5 videos, about 5 hours long. You also get 30 days free to our put selling newsletter. Our service is right here. We got 2 newsletters. We sell put options and we sell put option credit spreads. That's what we do. So if you get the video series, you get a free 30-day trial to the newsletter. We have our one-on-one coaching. If you know nothing about options, or even if you do know something about options, you want to get that next leg up, or you want to talk to me, I've been in this business for over 30 years. You can set up a one-on-one coaching session, and we have our probability calculator if you want to have a look at that. All right. That's it for me. I hope this has been helpful. I make these free videos for everybody. I'm trying to, get everybody to become a better options trader. Give me a like, leave me a comment, give me a thumbs up. Don't forget to subscribe. Hit that red subscribe button in the bottom right corner of the video. And you also have to turn on the notifications. So when I make these videos, you want to know when they come out, usually on the weekends. Send me an email. I'll always answer your emails. On the screen here, I'm going to put another video about buying deep in the money call options. That's the one that I concentrate on the most. You can look at that Warren Buffett book. And then lastly, down in the description below, I have links for, websites and books and other software that can help you with your options trading game. Okay, that's it for me today. I hope this has been helpful. This is Lee Lowell, and I'll see you in the next one.